Hello and welcome to our Business Owner webinar focused on how you can extract profits from your business in a tax efficient manner. You're going to hear three voices on the webinar, myself, John Spink, and Jonathan Cooper from Drewberry Financial Planning, along with Paul Aspen from Octopus Investments. Jonathan is our in-house technical guru at Drewberry and he's highly experienced and knowledgeable in tax planning for our business owners. Paul has been a development manager now with Octopus for 5 years and has a wealth of experience in financial services totaling over 25 years. Octopus are one of our trusted business partners and a highly respected provider of tax-efficient investment solutions. Welcome to you both. At Drewberry, we work with a lot of business owners across a wide spectrum of industries and services. Something they often have in common is being too busy managing the day-to-day activities of their business, and they do not get the opportunity to take time to plan their own personal finances. The result is missing out on valuable tax allowances and planning opportunities, which in turn has a negative impact on their future wealth and retirement plans. Many business owners come to us having built up excess cash reserves beyond those needed for a rainy day. With some good financial planning, there are plenty of ways we can advise in such circumstances to be efficient within existing HMRC framework. We all have the right to arrange our tax affairs in the most efficient way, so withdrawing cash from your company is no exception. Given there are a number of ways to take money out of your limited company perfectly tax efficiently without breaking any rules, the first big no-no is to consider practices or schemes that flout tax law or enter grey and murky waters. Such schemes are considered to be illegal tax evasion. If it sounds too good to be true, the chances are that it generally is. We work with our clients to ensure they extract profits from their companies using agreed allowances and solutions that sit within HMRC rules and guidelines. So enough from me. I'm going to hand you over to Jonathan, who's on our technical team, who will explain how we can work with business owners in the position and benefits of receiving sound professional advice. Before I do so, I'm going to just introduce you to our client we're going to be working with today for this presentation, and VJ. As you can see from this slide, VJ is a company director owner. He's built up some retained profit within the business, totaling £244,000, and he's come to us as an advisor to ask how he can start to maximise the allowances and ways of removing that money from his business in a tax efficient way. So, with no further ado, I'll hand over to Jonathan, who will take you through some of the more traditional ways you can do so.
Thanks, John. Hello, everyone. Obviously, the first thing we want to be able to do is VJ to be able to pay his bills every month. So we want to get some money out using sort of income, tax allowances, etc. So we can get basically £50,000 out as salary. For want of a better description, and only really pay 5.5% or 5.3% tax on that. The way we do that is splitting what's drawn out between salary and dividends. Salary should be drawn at around 8,632 in this tax year. That's a very specific figure, and it's a specific figure for a reason, being that is £1 less than when you start paying national insurance tax. But importantly, you still get a credit for your state pension. So basically you pay no tax on that, but you are earning a year's worth of accrual within the state pension regime. So that's very important. Thereafter, we're going to start drawing dividends. The next sort of 3,868, when added to the salary, will equal your personal allowance, £12,500 in the current tax year. Again, that's all tax-free, no income tax to pay, no national insurance to pay. The next £2,000 again will be dividends, and that is because each individual has a dividend allowance of £2,000 per tax year. So thereafter, we will carry on drawing dividends, but we're doing that sort of over any further salary, as dividends only attract 7.5% basic rate tax relief. So by drawing a further 35,500, we stay within the basic rate band, but we only pay 7.5%. So as I said there, I've taken £50,000 out and only paid 5.3% tax, so 47,337 into VJ's pocket, which is pretty good going. Thereafter, the sort of most common way to do this would be through the common way to carry on drawing money out of the scheme would be through pensions. Now, many people sort of are a bit nervous around pensions or sceptical about them, but they are, to be honest with you, one of the most tax efficient vehicles we have within the UK at the moment. The reason for that is you get tax relief on the way in. What you put in is tax relievable. Once it's in there, it grows free of tax as well. And given sort of freedoms that came around a few years ago, there are now sort of some very good ways of pulling money out the other end when you're retired in a very tax efficient manner. And one that's often overlooked is that pension pots, if they're set up correctly, are outside of your estate for IHT. So they are also an extremely good generational planning vehicle as well. So how much can we put into a pension? So if you're paying a contribution yourself, that is from the salary you've taken out of the company after you've paid tax on it, then you're limited to what you can put in, and that is broadly sort of 100% of earnings. Now, salary counts as earnings, but dividend doesn't. So in our example here, VJ was only drawing £8,632 salary, so he is limited to that amount as a maximum tax relievable pension contribution. But that salary link isn't present if the employer makes the pension contribution. Instead, that's sort of more limited by a wholly and exclusively for the purpose of trade test and something called the annual allowance, which is £40,000 per year. So VJ here could probably put in a good sort of £40,000 for the current tax year, and that would be fine as an employer contribution and be tax relievable. But it gets better than that, because there is a piece of legislation called carry forward. Now, what this does is it allows you to sweep up unused amounts of contribution allowance from the previous 3 tax years. So if we look at VJ and how this could work for him, then we can see what a useful playing tool this can be. So VJ, when he set the company up, he joins a pension scheme and just set it up as a £1,000 contribution going into his pension each month, and kind of forgot about it, to be honest with you. So as we can see, in the 2016-17 tax year, he put his £1,000 a month in, £12,000, but that is £28,000 less than the £40,000 annual allowance. So he has £28,000 of available carry forward that he can use in the current tax year. Same applies for 2017-18 and same again in 18-19. Coupled with the £40,000 annual allowance for this year, then he can actually pay an employer pension contribution of £124,000, get that out of the company, get the corporation tax relief on it, and pay no tax on it. So we've now managed to get £174,000 out of the company, an effective rate of tax of 1.53%.
Great, thanks Jonathan for running through that example. I think some really insightful information there, and probably quite surprising for many people listening today, is the extent of what you can invest via a company into a pension. A number of questions that sort of often get asked by clients I thought I'd be beneficial to go through today. So first one is, in terms of annual allowances, are they aligned with if I was a director, in line with my business year, or are they aligned with the tax year?
So personal allowances in terms of pensions and income tax and what have you, they are aligned with the tax year. If you're making employer contributions, then obviously your company year may not run in line with tax year dates, so they would be accountable within the year in which within the tax year in which your company year ends.
Another question that came up, and you mentioned it's something called wholly and exclusive for the purpose of trade, and that was determining in respect of employer contributions. Who decides that definition? Is that something that is done by myself or by my accountant?
So by HMRC's own admission, it's a bit of a grey area, and it really comes down to the local inspector of taxes. So what the wholly and exclusively test is really trying to do is just to make sure that the remuneration package as a whole, i.e. salary, dividend, any other benefits and pension contributions, aren't disproportionate to the work carried out by that person within the company. So if you're a company owner, director, and you're generating 100% of the profits or a large chunk of the profit, then you're not likely to have an issue with this. Where it might be an issue is if there are sort of sleeping partners, perhaps a spouse or something, and they only have a very minor role within the company, and you're trying to put sort of contributions in at the same level for them, then HMRC might take a bit of a dim view on that.
Okay. In terms of the carry forward exercise, you mentioned 3 years. Is there any circumstances that we can go beyond that, or is 3 years the limit? Three
years is the limit. It's a use it and lose it, like sort of your CGT allowance and your personal allowance. It's available for that year. So basically, in our example here, VJ, if he didn't make that contribution, then he'd lose the ability to carry forward from the earliest year, which is 2016, 2017.
Okay. And can all people use that 3-year allowance, or is there any examples where that might not apply to someone?
The main sort of reason people cannot claim it in full is because they haven't been an active member of a pension scheme. So that's what the legislation says, an active member. But essentially that means is even if you have an old pension scheme from way back when that you've forgotten about, as long as it's there and it's got your name on it, then you can use this carry forward.
Okay. And in terms of limits to my pension, is there an overall limit? You mentioned about the annual allowance. Is there an overall limit that I can have in terms of the value of my pension pot?
Yes, so there is. So that's known as the lifetime allowance. As we've seen, pensions are extremely tax efficient. So the government obviously wished to curb this. One method, sort of the amount they can tax relief you can get. So one method is that annual allowance. The other is the lifetime allowance, and that is the total amount of pension savings you can accrue over your lifetime. So the current limit on that is £1.055 million.
Okay, and in terms of that limit, what's the implications if I go beyond that?
Then the taxman takes his chunk, basically, on the bit above the lifetime allowance. Depending on how you take the bit above the lifetime allowance out of the pension, depends on what tax you pay. If you just take it as a one-off lump sum, it's at 55%. If you draw it as more of a regular income, then you pay income tax on that, plus you pay an additional 25%.
Great. Thanks, John, for that. I think it's been a really good example there of going through the more maybe traditional ways of extracting profits from a business. As per my introduction, I'd now like to pass you over to Paul from Octopus, who's going to cover off an area of tax funding investments that you may not all be familiar with. Over to you, Paul.
Thanks, John. Good afternoon, everybody. Yes, so Octopus Investments are a tax-efficient investment provider. We operate in a space where we utilise government incentives for investing into smaller companies to give tax breaks to clients, such as VJ, who we've been looking at today. These particular types of investments don't come without their risks. They're not suitable for everybody, and obviously under the guidance of a financial advisor, this is how the business comes to us. Clearly, tax legislation can change at any point in time, and investment into smaller companies can be more volatile than investing into large FTSE 100 stocks. Individuals' tax circumstances are obviously different, and at the time of writing, they will be applicable to that very investment as and when that is made. So just a few areas there to be aware of about the nature and the risks involved in the investment. A little bit about Octopus. So Octopus have been around for 20 years now. They are the largest provider of these tax-efficient investments in this particular space, both in venture capital trusts, enterprise investment schemes, and inheritance tax portfolios that qualify for business property relief. And as a specialist asset manager that work with smaller businesses, we've helped support well over 450 companies in their growth and development and going on to good things for the UK economy. And our assets under management are now well north of £7 billion. So we've got a long and established track record in this space. So what do we mean by tax efficient investments? I think potentially sometimes on the face of it they can sound a little bit scary, but these are not schemes. They're not loopholes. We're just utilising government incentives to invest in smaller companies to allow tax benefits. And what they actually do realistically is sit there right alongside traditional tax efficient investments that pretty much most people in the Drewberry portfolio will use as ISAs and pensions. You get your tax breaks with those two products for years and years and years now. Business property relief and venture capital trusts sit right alongside those, and they're very complementary. What we're going to do today, however, and in VJ's circumstances, is consider the venture capital trust structure. And this is how it looks. So should a client decide to go ahead with an investment into a VCT in any particular tax year, they will send their check in to the relevant provider, and they will purchase shares in that venture capital trust. As you can see from the slide here, the venture capital trust will then distribute those monies into the underlying companies that it holds within that portfolio. In this instance, we're just highlighting it that there's 4 companies, company A, B, C and D. The norm is that these portfolios are a lot more diversified, but this is just for kind of illustrative purposes. Once invested, the VCT will send out a share certificate to the client to say that you hold X amount of shares in said VCT, and a tax certificate to allow you to go and claim your tax relief. Many VCTs also target an extra tax benefit of paying out potential tax-free dividends along the way. So quite a tax-efficient investment vehicle. Overall, VCTs have actually been around in the marketplace in the UK for a long time, and as we've already heard, this it's an encouragement for the public to invest into smaller companies to help the UK, help entrepreneurs, and help us prosper, grow our businesses, employ people, pay tax, all the good things that the UK requires. The maximum amount that any individual can put into a VCT in any one tax year is £200,000. This is individuals only. This isn't from a corporate. It must be an individual investment, because what you're doing is claiming against your individual income tax liability for that tax year. The government will allow you up to 30% income tax relief against that investment, targeting those tax-free dividends, and should there be any growth within the VCT, that will also be free of any capital gains tax. So, how does this play out for VJ in what Jonathan's already taken him through with regards to his effective income tax solution alongside his dividend taxation from taking the money out of his business and pension contributions? So VCTs is an alternative, and again, VJ here has got £70,000 worth of retained profit that he'd still like to extract from his business this tax year. And in option 1 scenario, simply what he could do is pay himself that £70,000 as a dividend, taking him into the higher tax bracket of dividend tax, which will now be 32.5%, as opposed to 7.5%, which Jonathan's already used for his basic rate, and therefore incurring him a £22,750 tax liability. Clearly VJ can walk away with the difference after tax. Or in option 2, he can pay himself the same dividend from his business, creating the same tax charge, but here, where he's created himself a tax charge, he can drop that money into a VCT and claim back 30% tax relief, which in this situation is £21,000. So it's cost VJ another £1,750 in this scenario to take a further £70,000 out of his business. Quite a tax efficient means of doing so.
Great, thanks Paul. That's a really good insight into the world of VCTs. And I think it demonstrates that with good advice and planning, there are many ways that you can extract your profits from your company with a very low effective rate of tax. And in our example we've used today with VJ, having taken salary up to the NI limits and dividend payments at basic rate by using all the allowances of his pension and VCTs, we've been able to generate an extraction from the business of £244,000 with an effective tax rate of 1.81%, which is obviously a lot lower than one would expect. In terms of VCTs, Paul, I think there's a few questions that we get asked because it's an area that is not so well known. In terms of the tax certificates that you get for the VCTs, how do I claim for those?
Okay, so once the money is invested and as is classed as allotted into the VCT, the tax certificate and the share certificate is generally sent out around about 4 weeks after that allotment's made. The tax certificate is clearly the piece of paper that you need to either go via your accountant and claim your tax back through your accountant or the self-assessment at the relevant time of year, or you can make an interim claim to HMRC at any stage during the course of the year.
Great. In terms of the pension side, Jonathan was talking about sort of previous years and carry forwards. Are there any similar allowances or tax breaks that the VCTs can make use of?
There isn't with a venture capital trust. It's all about the tax liability that you're claiming against in the current tax year and therefore when the investment is made in that tax year. So you couldn't carry back, as with the quite nice routes that you can take through a pension. It's all about the tax year that you're in.
Okay. And in terms of the investments themselves, is it just in portfolio startup companies? Is that correct?
It's a good question. Obviously, when companies first come to a provider for venture capital, HMRC set guidelines to say how big those companies can be to ensure that they qualify for receipt of venture capital. If they qualify and get taken into a VCT, they can start to take venture capital investment and contributions. However, how big those companies grow to beyond that point, and while they still sit inside the VCT, is really exactly what the government wants providers to be doing with these VCTs. We want to be taking small entrepreneurial businesses, growing them effectively, helping them to employ people and do really good things for the economy. So depending on the VCT and the provider that you look to go with, you could probably find VCTs out there that deal maybe in just smaller startup companies, or some with a mix like Octopus, where you're going to have some smaller companies on their first round of funding for venture capital and some big ones that are well on their journey to hopefully good things.
Okay, so taking the right advice is obviously key for that.
Very much so.
VCT.
Yeah.
In terms of selling VCT shares, how do I go about doing that?
So VCT shares themselves are fairly illiquid, which is one of the reasons why they're deemed a slightly higher risk. So kind of how do you get out at the other end when you want to realise your investment, which is beyond the 5-year holding point. Now, they are shares after all, so you could go to a stockbroker to look to sell them on the open market. What they don't attract on the second time round when you go to sell your VCT shares is the income tax relief that you'd have been able to claim first time round. Therefore, they're not as valuable. Therefore, there's not really a second-hand market. What Octopus and do as a provider is to offer a buyback service at certain points during the year. This isn't always guaranteed, but it's something that we've put there to look to create a market for people wanting to sell their VCT shares. We offer a buyback service at the moment where we will buy those shares back at a current slight discount to their price of 5%.
Thank you. In terms of, obviously we looked at VJ as an example today. Are there any other sort of key taxpaying opportunities with VCTs?
Yeah, absolutely. So the way that legislation has gone in the UK, particularly around pensions and kind of the restrictions, as Jonathan mentioned, with sort of annual allowances and lifetime allowance problems, we're seeing a number of clients now who are potentially looking at investing into a VCT year on year, such as like an annual ISA or an annual pension subscription. So in this scenario here, we've got a gentleman who has the ability to invest £50,000 into a VCT every year for a 5-year period. Clearly, he's got the income tax liability to be able to claim back his full 30%, which is £15,000. Now, when we get to year 6, as you can imagine, as we've just discussed about buying back shares, he can look to sell his first year's investment. And what advisors and their clients are now looking at doing is maybe rolling that investment back round again into another VCT to claim tax relief. As you can see here, that becomes self-perpetuating on money that you've already used, taken from your business or assets that you've got personally, and it can become quite a tax efficient means of negating some tax liability that you've got.
Great. Thanks, Paul, for that. And also thank you again for Jonathan's we talked through in terms of the other more traditional ways of tax planning. I hope today that you've you obviously learned something and taken value from what we've discussed today. If there's any further information required, you'd like us to provide advice on your individual circumstances, please be in contact. Contact details are now appearing on the screen, and we look forward to speaking to you at some time in the future. Thanks very much.